a good psychologist will be a better investment than a good economist, if there's such a thing as a good economist, that is, because you're dealing with market psychology. Prices go up and people get excited. Prices go down and people get scared. It's been going on for centuries and will go on as long as we still have human nature. Whether AI ends up taking the human element out of it, I have no idea, but I suspect it won't, because somebody's got to push the button when the AI tells you to do something. And one of the strangest things is the best trades are the ones that you're really scared to push the button and enter. The ones where you're confident you've got it right.
Hello and welcome back to Trade of the World. They say music is the universal language. It has rhythm, patterns, and a structure that anyone can feel, no matter where they come from. Well, in the financial world, charts are our sheet music. Think about it. You can put a piece of sheet music in front of most people, and they will just see a confusing mess of dots and lines. But as a musician, like me, a trombone player, a musician sees a song. They see the melody, the harmony, and the rhythm. A financial chart is exactly the same. As our today guest says, a picture is worth 1,000 words, and a chart is worth 1,000 numbers. To the outside world, it's just a jagged, chaotic line, but to a trader, it's a composition. The individual price bars are the notes, the trend is the melody, and the volume is the tempo. You are not just looking at a chart, you are reading the music of human psychology. The language of charts isn't just numbers, it's the rhythm of fear and greed. On this show, we talk to the maestros who can hear that music. I'm your host, Flávio Lemos, so let's get into it. And I'm so excited because I'm not alone. I'm joined today by my friend and incredible host, Marcio Ferracini. Marcio is a market professional who has been living and breathing investment for over 2 decades, from the trading desks of Rio de Janeiro to the foreign fast screens of Chicago, and now Miami. Ferracini is a chartered market technician. He holds an MBA from Duke University and a master's in finance from Illinois Tech. But what he really drives him in blending is his blending art and science in the market. For more than 20 years, he has used a fusion analysis approach, mix quantitative models, technical data, and a solid dose of fundamentals to separate the noise from the trade. When he's not looking at charts or testing one more brilliant idea, you will probably find him biking around South Florida or joking that discipline is the only egg that doesn't decay with time. He has worked across the full investment spectrum, combining the mindset of a trader with the structure of an institutional advisor. Ferracini later joined global players like Franklin Templeton and BTG Pactual, where he helped connect investors and multifamily offices to global market. Hello, my friend Marcio. How are you?
Hi, Flávio. It's a pleasure to be here. Thank you for the introduction. In another occasion, we can dig deeper into the model that I've been using over the years, because today we are together here with a legendary technician, Walter Deemer. It's a pleasure to have this conversation. Walter was one of my sources when I started studying technical analysis, so it's really great to be here.
All right, Tim. Before we dive in, the ritual sacrifice to the YouTube algorithm. If this chat deposits any value into your knowledge account, smash that like button and subscribe. Well, as Marcio said, today is a very special day. We often talk about market wizards and gurus, but today we are sitting down with a man who has literally seen the entire symphony played out for over 60 years. He started his career on Wall Street in 1963 Yes, before many of us were even born, he worked with the legendary Bob Farrell at Merrill Lynch. He navigated the golden years of the 60s at the Manhattan Fund, and he was a founding member of Market Techniques Association. No conversation about technical mastery is complete without mentioning our guest, the legendary Walter Deemer. Walter isn't just a technician. He's a market historian and a master of anticipatory analysis. He has spent his career whispering in the ears of institutional giants, telling them when the tide was about to turn before anyone else saw the waves. We are going to talk about his incredible journey, his books, his unique indicators, the Nifty 50, and yes, we might even get a joke or two of him, but it's difficult. A titan of the industry and a founding member of the CMT Association, Deemer is celebrated not just for his analytical process, but for incredible ability to distill market psychology into sharp, memorable wisdom. While his book, Deemer on Technical Analysis, is a foundational test, he is perhaps most famous for his extensive collection of market aphorisms. He actually gathered these decades of insights and witty one-liners into the cult classic, When the Time Comes to Buy, You Won't Want to, and a book that essentially functions as a masterclass in trading philosophy told through the quotes. If you want to watch CNBC like the pros do, just turn off the sound and pump up the volume of our YouTube. Walter, it's an absolute honor to have you on the show. Thank you. You are welcome.
An honor to be here.
You cannot afford to miss this. Don't go anywhere.
You ever wondered what truly connects traders from Tokyo to London to New York? You just need to learn the language. That language is technical analysis. Understand its signals, and you'll understand the world. Welcome to Traders of the World. Here we skip the jargon and just figure it out together.
Walter, you have a famous quote that every trade eventually learns the hard way. And it's even the title of one of your books. When the time comes to buy, you want to. And when the time comes to sell, you want that either. You lived through the 62 crash and the 74 bottom. Why is human nature so hard to overcome at these pivotal moments? You mentioned that the 62 market crash was a pivotal moment for you. While everyone else was panicking, the technicians saw it come a mile away. What exactly did you see in the charts back then that the rest of the world missed? What was the context when you coined that quote?
Back when? And the market had really been going up from 1949 without too much of an interruption to 1961. In 1961, it got fairly speculative. In those days, we had the American Stock Exchange, the old curve exchange. And that's where the riffraff of the world traded. And in May of 1961, we had 2 days when the American Stock Exchange traded more shares than the New York Stock Exchange for the only time in history. This was electronic stocks, bowling stocks, vending machine stocks. So we had a big binge of speculation in May of 61. And then the averages led by the big predictable growth stocks, Procter & Gamble and Texas Utilities, struggled up to make higher highs in December. The big tell was the advanced decline line. The advanced decline line had one of the biggest divergences it's ever had, and that's when I guess it get most of its popularity. Joe Granville was pointing out, a number of people were pointing out, that back then nobody really listened to technicians, so nobody really saw it coming.
Okay.
Also, talking about markets goals, you've also famously said that the 4 costliest words in financial markets are This time is different. After 60 years of watching this happen, do you think the market has a personality? Or is it just a collective madness of the crowd reflected in price?
It's been said, and I fully agree, that a good psychologist will be a better investor than a good economist, if there's such a thing as a good economist, that is, because you're dealing with market psychology. Prices go up and people get excited. Prices go down and people get scared. It's been going on for centuries and will go on as long as we still have human nature. Whether AI ends up taking the human element out of it, I have no idea, but I suspect it won't, because somebody's got to push the button when the AI tells you to do something. And one of the strangest things is the best trades are the ones that you're really scared to push the button and enter. The ones where you're confident you've got it right are usually the ones that don't work. Again, it's just psychology. The market is a cruel mistress.
Another famous quote that you have, and this may relate to your one of the persons you had the pleasure to work with, Bob Farrell, is that stock is not always the same as the company behind it. You had an incredible opportunity to work with Bob Farrell at Merrill Lynch early in your career. You've called him a contrarian thinker. What was the most enduring lesson you learned from him about reading market sentiment and going against the crowd?
Bob started me taught me that it pays to be contrary. And it's crazy, but no matter what market or what you're talking about, whenever some sort of sentiment gets deeply entrenched, the market usually goes the other way. Again, it's partly human nature, and partly the thing is, if everybody's bullish, let's say 98% of the people are bullish, it only takes 1% to turn bearish to turn the market. Even though when the market turns, they're still 97% bullish. So going against the consensus usually pays off pretty well. And the problem is that the consensus is also the people I used to work with at the big mutual funds and money managers. And as a friend of mine, Dean LeBaron, once pointed out, telling the majority of your clients they're probably wrong is not a really good business model.
Yes.
But it's crazy, because the thing is, it worked when I was at Putnam, and it worked when I was working with other institutional clients, that if I made a case, let's say I made a bearish case, and everybody slapped me on the back and said, "That is wonderful, we agree," and rushed into the trading room with sell tickets, I would go back to my office and try to figure out what I had done wrong. But if I made a bearish case and everybody looked at me like I had two heads, one of them being orange, then I went back to my office and said, "I probably got it right this time." So it's just, again, it's human nature. Human nature just doesn't change. It's not going to change. We're humans. As long as we're humans, it's not going to change.
Another famous quote: "No stock in an uptrend ever gone bankrupt." You describe your style as anticipatory analysis. You told a fund manager once that you couldn't just tell him when a stock broke out. You had to tell him before it broke out, so he could buy size. How do you hear the notes of a trend change before the rest of the orchestra starts to play?
With extreme difficulty. The problem, when I worked at Manhattan Fund, Gerry, Tsai, the go-go manager, used to love breakouts. Show him a breakout and he'd get all excited and start buying the stock. So when I went to Putnam, I showed the largest fund manager a breakout, and he looked at me and said, "I'm sorry, that doesn't help me. I can't buy it in size." you have to tell me before it breaks out so I can buy it in size, which, as I hope you will agree, is a lot tougher than waiting for the breakout to actually occur, because a lot of anticipated breakouts never materialize, such as the problem of life. But that was the job I had to do, so I tried to do it.
Walter, you have pointed out a fascinating parallel between today's Mag 7, the Magnificent 7, and the Nifty 50 growth stock saga of the early 70s. Here I need to mention, because it's a global show, it's important not to confuse the historical US Nifty 50 with the modern day Indian Nifty 50 index. So we are talking about the US Nifty 50, not the collection of 50 companies on the National Stock Exchange of India. So the Nifty 50 was a group of 50 favored large cap stocks on the New York Stock Exchange in the 60s and 70s. They were known for consistent earnings growth and high price to earnings ratios. But people forget that the Nifty 50 companies actually had great earnings, growing 25% a year. But the stocks, even with earnings, crashed anyway. So can you tell us that story? What happens when great companies get too far ahead of themselves? What's the lesson there for investors today who think good earnings always equals safe investment?
That's the point. Good earnings don't always equal good performance. That back, what happened in the early 1970s, we had come off a 1969-70 bear market, which worked off the speculative excesses. And this is a monthly chart of the McDonald's Corporation from 1970 till 1981. And this line here is an earnings line. And these are from Securities Research Corp in Boston. And the chart is plotted so that when the price is on top of the earnings line, as it is here, it's selling at 15 type earnings. So it's way above it. It's selling at a lot higher than 15 types earnings, and so on. So you can sort of imply what the price earnings ratio was. And what happened in the early 1970s, we had horrible inflation and high interest rates, and these consumer growth companies, the McDonald's, the Avons, the Baxters, the IBMs, the Texas Instruments, the Xeroxes, the Shearing Plows of the world, were predictable growers, and investors were going into them as a haven from all the uncertainty everywhere else. And it turned out it boiled down to basically about 50 big stocks, and they were tagged the Nifty 50, just as the Mag 7 now are dubbed the Mag 7. Yeah. And what happened was, in 1973, Putnam was buying it at 75 times earnings up here. And in 1973, if the analysts had correctly told you that McDonald's earnings were going to grow at 25% per year, these are log scales, which I'm very insistent on. So these are percentage changes. So what this means is this straight line, best straight line in the world, meant that McDonald's earnings per share were growing at 25% per year, compounded throughout the 1970s. And what happened was the stock got ahead of itself and it corrected, and excesses very often lead to excesses in the other direction. And so McDonald's ended up in 1980, after generating 25% growth for 7 years, in 1980, the stock sold at 8 times earnings. And talk about psychology. Look, Putnam was a big growth stock, a Nifty 50 growth stock shop. The biggest one was Carl Hathaway at JP Morgan, and he got all the press because he was in the media capital of the world. But Putnam was just as big, so we didn't get tagged with it quite so much. And the Nifty 50 just got ahead of themselves. Everybody was piling into them because it was the only thing that was working. And gradually performance eroded and performance eroded and performance eroded. And all the money that came flooding into Putnam and the growth stock managers in the 1972-73 started leaving. And so Putnam ended up having to sell it. And I happened to be the special guest on the late lamented Wall Street Week TV program in February 29th, 1980. And that was right near the bottom in McDonald's. And I wanted to be able to mention McDonald's as a good-looking growth stock to buy if the subject came up, which I knew it would. And I was told I could not mention McDonald's on the Wall Street Week TV program because the advisory company, which had been buying it back in 1973, had a sell program underway. And I got ticked, and I wrote an inter-office memo to the big leading people in the investment department. And I said, I can't mention it because the advisory company has a sell program, even though it looks to me like the stock is finally bottoming. And then I said, if this isn't a major buy signal, I don't know what is. But the problem was that the money managers, you have two kinds of people at the money manager firms, the people who actually run the money managers themselves, and then the people that are running the business. And the people that were running the business sold themselves to clients as a Nifty 50 growth manager. And so when the music changed, they weren't able to change and they got stuck. And the only reason I dwell on this so much is that I just wonder, as I try to fall asleep at night, whether this might be the way the Magnificent Seven finally ends up. Because the dot-com boom of 1999 and 2000, the dot-com boom, a lot of those companies never had any earnings. That the internet was going to change the world, we all said, and it did indeed change the world, as we are demonstrating at this very instant. But it was tough to buy stocks that you could buy. I remember I once went, when the internet was just starting, that I went to Fidelity, which was one of my clients, and I said, you have a lot of select funds, you ought to have an internet fund. And the response was, do you think we can find enough stocks to buy? And I said, well, I guess you put 5% in Microsoft and 5% in Intel and then go from there. But, it was tough. And then all of a sudden they came out of the woodwork. So the dot-com bubble ended with a lot of companies that didn't make it. The Nifty 50, the companies are pretty much all still around 50 years later. McDonald's, you can still go buy hamburgers at McDonald's all over the world. There's a McDonald's everywhere. But the stocks just got ahead of themselves. And I wonder whether the Nvidias of the world at some point are just going to get ahead of themselves. That somebody once described the growth stocks as, when they were selling at ultra high multiples, that they were not only discounting the future, but they're now discounting the hereafter.
Olá, espero que esteja gostando da entrevista. A Trade Brasil foi eleita por 2 vezes no Rank Awards 2024 e 2025 como a melhor academia de formação de investidores do Brasil. E ela tem um presente para você que está assistindo esse podcast. 10% de desconto, é só usar esse QR Code que está aqui embaixo e a gente te espera lá, ok? Agora não esquece de dar uma moral pro Flávio. Curte, compartilhe esse vídeo e se inscreva no nosso canal, ok? Até a próxima e obrigado pela presença. Valeu!
So, hence the Nifty 50. So, history, I'm a big believer. History doesn't repeat, but it rhymes.
Yeah, that's
And
true.
it rhymes because human nature is unchanging.
Yeah,
Now,
that's very
now
true.
the next question is, when does Nvidia get ahead of itself? And my response is, I haven't the faintest idea. I know it will at some point because they always do. I'm 84, so I may not live long enough to see it. You young guys may not live long enough, but it will happen at some point. It does. It just always happens.
But it's tough to go against the crowd because it's like a mammoth or a lot of elephants passing
Yeah,
over you.
yes, a lot of elephants, and you're telling everybody in the room that they're probably wrong,
Yeah,
which is not easy to do. You know, I'm I march to the beat of a different drum. I don't get along with people, so I don't have a whole lot of friends because I tell them that they're probably wrong. Although I live in a senior living facility, and the residents here are fond of telling me what the market's going to do. They never ask me.
But it's clear at this point that the stock market is a better communicator and a better economic forecaster than most economists and even fundamental analysts that are out there. So switching gears a little bit, speaking of reading the market's tempo, you've made a fascinating observation about price gaps. You said how quickly the gaps get filled, if they are filled at all, gives us an idea of how strong the underlying trend is. Could you expand on that? And what does that mean when the gap refuses to be filled, and what it tells you about the conviction behind the current move?
Gaps are a handy dandy instant indicator, so you don't have to wait all your lifetime to see if it plays out. And first, I need to define a gap. A gap, an upside gap, is when today's intraday low is higher than yesterday's intraday high, not closes, intraday. A downside gap is when today's intraday high is lower than yesterday's intraday low. So there's a hole in the market that I understand that the Japanese call them windows in their candlesticks. And we have a saying, there's a saying going around which isn't true, that all gaps must be filled. And there's a saying in Japan, I understand, that all windows need to be closed. Unfortunately, there is no law on Wall Street that says gaps must be filled. And I'm sure I can go find a gap from 2008 when the market finally, 2009 when the bull market finally started, that hasn't ever been filled. So, but the normal tendency for a gap, again, today's range is outside of yesterday's range. And the normal tendency is for a gap to be filled rather quickly. And when it is filled rather quickly, this is sort of normal behavior. When it's not filled quickly, it's like Sherlock Holmes and the dog that didn't bark. If the gap isn't filled, then it's trying to tell you that the underlying trend is strong. And I'm going to divulge. I'm a big believer in the underlying trend. A guy named Frank Peluso, the late Frank Peluso, came into Manhattan Fund with cycle analysis, and he broke the market down into 2 to 10 day cycles, 2 to 10 week cycles, and 2 to 10 month cycles. And he would generate buy and sell signals. So he said, you want to try it out? I will call you when we get no signals. I said, fine. So Gerry said, fine, let me know. So Gerry was fighting the tape, and as he very often did. And so he was bullish when the market was bearish. And Frank Peluso called up and said, we got a 10-day buy signal. And Gerry is all happy and everything. He figures he's going to get 10 days of relief. And a day and a half later, Frank calls up and says, we got a sell signal. And Frank and Gerry Tsai starts muttering in Chinese or something like that. And I told Frank, things are not going well. Your 2 to 10 day buy signal didn't even last 2 days. And he says, no. What that means is the underlying trend is so powerful that it aborts a normal signal. So the 2 to 10 day buy signal was negated by the 2 to 10 week cycles and the 2 to 10 month cycles, which I call the underlying trend. So when the market is doing something beyond normal expectation, and in this case, let's say when it doesn't fill an upside gap, it suggests the underlying trend is unusually strong. And so you've got more wind at your back than you normally do. So I'm a big believer in trying to identify the underlying trend by things like, do gaps get filled? If the gap gets filled right away, normal. If the gap doesn't get filled right away, the dog didn't bark and it's trying to tell you something.
Great.
You know, we're always looking for clues. And we're like Sherlock Holmes. It's like an investment manager has his tax pulled for audit, and the IRS agent says, "Oh, we call returns like this. We call them Sherlock Holmes returns." And the guy said, "What do you mean?" And he says, "A lot of amazing deductions." So we're trying to make deductions given information, and one of the things that you can get information from, in my opinion, is gaps, whether they're filled or whether they're not.
Walter, let's get practical. As you said, price is everything. We ask every guest this question because it's always the most insightful. Could you walk us through 2 trades that have stuck with you? First, your best trade or best call, not just in terms of profit, but the one you are most proud of, analytical and execution standpoint. And on the flip side, what was your worst trade, the one that delivered the most painful and probably the most valuable lesson of your career? If you are willing, let's go.
I'm trying to think of my best trade because there's so many of them. But the worst thing I ever did, I came up with a concept called breakaway momentum, which is the extraordinarily powerful momentum that's generated only at the beginning of a powerful move in the stock market. And if you go on the internet and Google breakaway momentum, you will find an explanation of what it is. Basically, it's advances have to be about two times declines over a 10-day period. It takes a full 10 days to generate it. It's not one of these handy-dandy instant breath threats that everybody's playing around with. You know, this is there's been, I think, 25 or 26 of them in the last 80 years. So it's not a dime a dozen. Usually it triggers at the beginning of a 4-year cycle. So we have some rather severe market unpleasantness in 2008 and early 2009. And we are looking at the end of the world as we know it. Wall Street is about to crumble into oblivion. Things were bleak. And the thing was the great financial crisis. You know, people were saying this time is different. So the market, lo and behold, in I think it was March, either late March or early April of 2009, generates breakaway momentum. The blue ribbon, it's generated 26 times since World War II. Only one of them screwed up. Pretty good batting average. And they usually lead to really big moves too, which is what you live for. So the market generates breakaway momentum, and I sit down and I say, yeah, market generated breakaway momentum, but because of all the financial problems that are going on, this time is different. this was not a good thing to say. Lo and behold, in the summer of 2009, the market generates breakaway momentum again. And I said, this time is different. And then it generates it again in the autumn of 2009. And I said, no, it's not. This time is different. You have to understand. And unfortunately, somebody did some work on breakaway momentum in the 1930s, and breakaway momentum did not work. Breadth thrusts did not work in the 1930s. I do not know why. They've worked perfectly well since 1945, and I guess that's what I'm dealing with. I don't know what changed at that point, but and they still work. That we just miss this year getting breakaway momentum. That it's a 10-day total of advances compared to a 10-day total of declines. On day number 10, the drop-off number was minus 200. All we needed is a day with fewer than 200 declines to generate it, and the market went down, and we just missed it. And we did get a Zweig breadth thrust then, and I tip my hat to the Zweig breadth thrust. It's one of the breadth thrusts that I trust, and there are not many of them. And obviously, a long-term buy in June of 2025 worked well. So, but ignoring 3 of them, they're supposed to be one every 4 years. Ignoring 3 of them still bothers me. That I did, and I will also add, and this may be the Achilles heel of AI, is when you get a signal, do you act on it? And at one point, Wellington had a technically oriented fund, and it didn't do well, and Wellington ended up closing the fund. But one of the fund managers was asked why the fund didn't do well, and he said, we didn't follow our signals. So getting a signal and acting on it are 2 very, very different things. And as I am fond of saying, if you get a signal and you can't believe it, so you actually have to force yourself to hit that enter key on your keyboard, and then you vomit afterwards on your keyboard, it's probably a good signal.
I'm actually doing a work here with a Brazilian market with breadth indicators, and Greg Morris is a close friend of mine, and he has a whole book about breadth indicators, a lot of indicators. I think you are there, but you have Zweig breadth indicator. You have stocks above the average, stock below the average, stocks above their side. There are tons of different indicators, but to adapt to a different index, I think is a problem, because your exchange is like 5,000 stocks, 4,000 something stocks. The whole index is like 5,000, almost 5,000 stocks. And the Brazilian market, for instance, like
3,000 that trade on the New York Stock Exchange every day, maybe 3,000 or so.
3,000.
Yeah, with liquidity. Yeah.
So, but if you want to adapt, for instance, to the S&P 500, the numbers will be different.
Exactly, which is why there's a gentleman named William Whaley who's done a lot of work on this in Huntsville, Alabama. And he points out he doesn't like to use the S&P 500 breadth because one order in the S&P futures or the SPY ETF can make all 500 stocks move at a time. So he has gotten better results using the entire market breadth. So I'm old. I don't trust new stuff, and then I don't trust just S&P breadth. If it's generating strong breadth in the whole market, then I believe it.
Yeah,
And by the way, a
you
lot of
got all the
people,
history of the rest.
yeah, a lot of people don't like to use overall market breadth because there are too many interest-sensitive stocks. And my rejoinder is interest-sensitive stocks are supposed to lead the rest of the market. So maybe having a lot of interest-sensitive stocks in the breadth numbers is really a positive rather than a negative.
Okay, let's change a bit of subject. Do you think keeping a sense of humor is essential for longevity in this business? We have seen booms and busts that destroyed careers, yet you are still here, laughing with health. Is humor part of your risk management?
Yeah. I was a caregiver to my wife who had dementia and passed away a couple months ago. And I went to a lot of caregiving support groups. And the rule of thumb is if you don't laugh, you'll cry. And the business we are in creates a lot of stress because, unlike almost anything else, when you are predicting a stock price, you're going to be proven, and this goes for any place in the world. I mean, you can look at the stock chart. It doesn't matter, if it's in the United States or in Brazil or in India or in anywhere. A stock chart is a stock chart, and you are going to be proven right or wrong very quickly because that little number on your screen is either going to go your way or the other way. And none of us is perfect. Maybe you are. I don't know. I'm not. And and so it's a humbling thing. And as has been famously said, prices are never seasonally adjusted. The price is what it is. The price is everything. It's not going to be whatever we close at today is what we close at today. You may not like it. You may disagree with it, but it's where we close. It is what it is. And it's concrete and unadjustable. It will change tomorrow, but today it is what it is. So the thing is, there's a lot of stress. And I think, if you can chuckle a little bit while you're going through your daily operations and your weekly operations, it may take some of the stress off and you can live long enough to enjoy the benefits of the money you're making.
As I listen to you say, it is what it is, and also bringing the humor part to the market. I remember when I was in Chicago and I was managing a book of options through the expiration cycle. I remember people joking about my accent and talking like a the character in the markets. Marcio, don't try to micromanage too much your positions. And you have one of this phrases that you used to say that the market will do whatever it has to do to embarrass the greatest number of people to the greatest extent possible. How does your Deemer's law of perversity work?
It just works. It's contrary opinion to the next degree. Contrary opinion, basically, and this is oversimplification, says the market will do something that most people, when everybody agrees that the market's going to do something, it'll probably do something else. So my law of perversity takes it the nasty step further. It says not only is it going to do something else, but it's going to embarrass as many people as much as possible. And go back and look. It does. That's the way it works. I don't make the rules.
Yeah, when everyone is most optimist, that's when the tops are made.
Yeah,
I tend to agree with that.
Not only optimistic, but they're optimistic and pound the table. And they do it on TV or something like that. And one of my sayings is, if you want to watch CNBC like the professionals do, turn the sound off.
Yeah. There's a story, you and John Bollinger, with this, about this quote. How was the story?
Which story?
With this, about, I think it's a CNBC story, that somebody got a sign and John Bollinger took the sign.
Yeah. I did a presentation at an MTA seminar, and part of my thing, because I like to do sort of funny things along to keep people from falling asleep, and so what I was doing was quote, selling things from the South Florida chapter of the Market Technicians Association.com website, which never existed. So one of the things was we had a bunch of rulers that we sold. That we had a 6-inch ruler for short-term trends, and we had a yardstick for long-term trends, and we had a tape measure for secular trends. So one of the things that we were selling was a big sign that said in big letters, "Turn the sound up." And we were selling that to people that were guests on CNBC, to hold up when they started their appearance so people would hit the unmute button and listen to them. The funny thing was that John Bollinger, who is a great technical analyst, he's done a lot of pioneering work, was very often on CNBC. And after my talk, he insisted that I give him the sign. And I don't know whether he ever used it or not, but he did get the sign.
I will talk with him.
So if you're ever on CNBC, just get a big sign that says "Turn the sound up," because otherwise it's on mute. And the other thing that I have fun of doing is like, the markets, when we started this was up big today. So if it continues up big, I can say something like, I don't have to watch financial TV tonight because I already know everybody's going to tell you they bought last Friday.
They are always right.
Yeah, and they are. The only thing is, you could make a lot of money if you had a time machine.
Yeah.
So instead of doing all the, ask AI how to do a time machine, then we could get rich.
Go, Marcio.
Never confuse a bull market with brains.
Yeah, don't confuse.
That's wise. That's wise.
Everybody makes money in a bull market, and then comes along. Nothing goes forever. Even bull markets. Every bull market in recorded history, in every country of the world that has a stock market, every bull market has been followed by a bear market. The question is when.
Yeah.
As I understand, as long as the market breadth keeps playing on the side of the market, we are safe. But when the music stops tuning, that's when we are going to have problems. And I know about reading your work throughout the years that you have a deep appreciation for market breadth too. So you mentioned back in the day that every major institutions had a low risk buying power and selling pressure chart on the wall. Why is it that you consider breadth, which is measuring what the average stock is doing versus the indices, so critical for your long-term analysis of the markets?
Because it's analyzing what the market is doing, not what a handful of stocks. And I have a bone to pick with all the market indexes because they're all distorted by something or other. Right now, the Standard & Poor's is distorted by the Magnificent Seven, and the poor fund managers who are trying to be closet indexers, a lot of them aren't allowed to own more than 5% of the fund can't be more than 5% of the stock. So If Nvidia has an 8% weighting, they're by definition 3% underweighted. So by following market breadth, you're following what the entire market is doing, not just a couple of headliners. And the Lowry's takes it further. What they do is the basic Lowry's thing is how much volume it takes to move stocks a point, which is their buying power and selling pressure. And the nice thing about it is they've been doing it since 1937. So you've got history. Unlike a lot of things, you've got history. It goes way back into the dark ages. So it can give you some long-term perspective. So what Lowry's does is just incorporate market, the breadth of the market, and then the volume across all stocks as well. So it's going one step further.
There is another quote from your book. If you need an indicator to tell you whether sentiment is extreme, it's not. I love your stories about the old indicators that have vanished, like the odd lot houses. You said they were almost always right at major turns. Do we have any modern equivalent today? Is there any group of investors you watch now as a reliable contrary indicator?
We do not, which is why I'm retired. Because I could not find anything. But the oddlotters, it used to be oddlotters were people who bought less than 100 shares. Used to be, back in the 1960s, they accounted for 10% of the volume in the New York Stock Exchange. So analyzing what they were doing was pretty important. And we would get odd lots every morning. The odd lot houses would release the number of shares their customers bought, the number of shares their customers sold, and the number of shares their customers sold short. And it turned out to be, it was a great window on what sentiment was doing. Because again, as a contrarian, you want to go against sentiment. And it's like during the crash of in 1962, the last few days on the downside, they swung from being on the buy side. Normally, oddlotters buy 10% more shares than they sell. They used to. They don't. And on the way down, they stepped up their selling. So finally, the day of the bottom, that they sold 130 shares for every 100 they bought, and the market staged a huge reversal and closed way up on the day. And the next morning, it was Memorial Day, so that the market was closed on Memorial Day, and then on Thursday the market opens way up, and it turns out the oddlotters bought 3 to 1 on the buy side, and that was the end of that particular recovery rally. So you got great insights, but it doesn't exist anymore, and I don't know how to find them. And as I say, that's why I've retired.
You have said that technical analysis is an art, not a science, because you can always build a bullish case and a bearish case at the same time. The art is deciding which one to believe. After 60 years, what is the X factor or intuition that helps you decide which case is the right one?
I'm still learning. I mean, I'm still trying to figure it out. A question before the House now is, in the U.S. market, and I guess all the other markets in the world, what would end the bull market? And the normal things that end the bull market are the Fed tightening, which it ain't going to do, or over speculation, which may be creeping up, but this is not like the dot-com boom. This is not over speculate, in my opinion. And the third thing that very often does it is you go into a recession, because the stock market's a leading economic indicator, and that may be a possibility. But as David Fuller once said, the Fed has caused more bear markets than all other factors combined, and the Fed doesn't seem to be in the mood to cause a bear market at this point.
Quoting another one of your phrases about institutional volume and participation in the markets. Quotes, watch their feet, not their mouth, unquotes. You've mentioned that institutions are the elephants of the markets, making the trends, but retail traders can be very flexible. If you're starting out today as a retail trader, armed with just a laptop and your knowledge, how would you try to dance around those elephants?
I'm not sure, but remember when I said that the toughest thing is to follow a signal sometimes. And so the thing is, you may have things that work and work reliably over a long period of time, but when you don't believe them and it's tough to follow them, that's when they separate the men from the boys, or the adults from the children, I guess I should say. They say that when you get a signal and you're reluctant to act on it, as I was reluctant to act on Breakaway Momentum in 2009, they're the ones that work the best. So,
nobody knows how traumatic a test of a low is until they have lived through one. Walter, you have seen booms, busts, inflation, crashes, AI, McDonald's, Nifty 50s. So for the new generation of traders who have only known the last decade or so of markets, what's the one timeless piece of advice or a history or a joke you would give them to survive the next 40 years?
Let the market tell you its story. You know, whatever it is, that whatever you happen to think, the market doesn't care what you think. So, you know, don't be wedded to what you think it has to do, and listen to the market tell its story. And if you listen to the market tell its story carefully, you will do okay. But you have to listen carefully and without bias. You know, don't be a perma bull, don't be a perma bear, and be willing to change your mind when, you know, the facts change, because you will be wrong. Any you will be wrong at some point in your career, probably more than once, and probably embarrassingly so. So, as somebody once said, it's not being wrong that's the problem, it's staying wrong that's the problem. So be willing to be flexible. The market is flexible.
Yeah. So, Walter, you really are the maestro. Thank you for the history, the wisdom, and especially the laughs. It's hard to find someone who takes the market so seriously, but doesn't take themselves too seriously. Thank you for sharing your stories, your anticipatory insights, and for reminding us that while history doesn't repeat, it often rhymes, especially when it comes to the Nifty 50. Thank you very much.
Thank you for having me. It's been an honor to be with you.
Thank you so much.
Thank you, Marcio. So that's all we have for today on Traders of the World. A massive thank you to the legend, Walter Deemer. Thank you very much, Walter. And you are our guest. I'll tell John Bollinger, you told him a story. He is my sponsor at the CMT Association, and we are very closely related. This year, I invited him to Brazil to speak for the second time, and I was with him at the stage on a big event here. And I know all the family, his wife, and his daughter, Zoe, who was actually in our show together with him. So thank you very much, Walter, for everything.
Thank you both. I appreciate it. And it was a pleasure.
Well, thank you. So,
and I will tell you too that I think Meet is a lot easier to use than Zoom.
Yeah, it's easy. You just have 3 buttons.
Thank you very much.
Okay, Walter. Bye-bye.